Hey, good morning, everybody, and welcome to the March 2022 edition of our Inner Circle workshop. My name is Brad Gatto. I'm one of the owners and founders here at Fiat Wealth Management, and really excited to have all of you here. I'm looking at all of the participants that we've got in the workshop already this morning, and we've got some regular attenders. Glad to have you back. Thanks for being here. And we've got some new names and new faces, so that's exciting as well. If you're unfamiliar with our Inner Circle workshops, these are meant to be fun and educational. And we do something called a fun and friendly quiz. Keywords there, fun and friendly. So don't feel pressure when we get to that part of the workshop today. And as you all probably know, because you registered for it, this month's workshop is on taxes. Now, I always feel a little bit bad when we do a big topic like this, because we're never going to get through all the questions that everybody has on taxes in an hour. But I will tell you, flow or format of today, I've got some housekeeping items I'm going to go through with you here up front. I actually have a special guest host with me today. I'm really excited to introduce all of you to here shortly. And so we're going to do that. We're going to go through the fun and friendly quiz. We're going to let all of you take the quiz, and then we're just going to walk through the questions. And so that's going to be the format of today. I will also say this. My hope is that if we can get through this in a timely manner, that we will have time at the end of our fun and friendly quiz and the walkthrough of it for a Q&A. And so if you have any specific questions as it relates to taxes, not specific to your situation, but just tax questions in general, I want you to be able to ask those questions in the chat box on the I think it's on the bottom of your screen. Yeah. So on the bottom of your screen, there's a little chat box. If you guys could jump into the chat box and just type hi, good morning, something, whatever you want to type in there, because you can see me, you can hear me. I can't see you. I can't hear you. I know you're there because it says you're there, but good morning. Good morning. Good morning. Thank you for saying hello. Yes. Thank you very much. Makes me feel like I'm actually with you. So that is awesome. That said, a couple of updates before we get into the content for today. If you have not yet noticed, I'm going to share my screen and show this to you. Good morning. Good morning. I thank you everybody for jumping in there. The Fiat website is under construction. Now the picture, I say that, I didn't actually mean to do that. The picture looks like that's like a temporary picture because it's under construction, but the whole theme of the website is changing a little bit. If you have been a part of the Fiat family for some time, you'll know that we use the analogy of home building in throughout our financial planning process. And so we just thought it made sense to rebrand the website to match that. But outside of the rebrand and kind of some of these pictures, we're trying to make it easier to use for all of you and give you as much information about our firm as possible and education. As you know, if you've been a part of Fiat for any amount of time in our family, we're really big on education. We love educating people and empowering you to make your own decisions. So a couple of things I want to point out. If you go to the About section here, what you're going to see is our new team picture. We've added some team members since the last team picture, and so we got a new picture taken. So there is everybody. That's great. Below that, there's individual pictures of all of us. And what is kind of cool, I think, if you click on the Learn More button here, it's not going to take you to a written bio of that particular person at Fiat. It's actually going to take you to a video. We all recorded videos and did little short, 30-second to minute and a half long bios of who we are. And so if you're bored on a Wednesday at 12:05, because obviously you wouldn't be doing it now, you're on today's workshop, go ahead and check that out. Education, this tab is really important to us, and you're going to notice a complete redesign of this page. There's our very own Scott Airy, who is on spring break today, which is also why I don't have Matt, by the way. My normal co-host, Matt Stahl, and the other founder and partner of Fiat Wealth Management, left this morning for spring break at 6 a.m. He, his wife, and his 4 kids and his dog all piled into a car to head to Tennessee. Now, I've heard along the way this saying that if you are going on a vacation with your 4 kids and a dog, that's not a vacation, that's a trip. So I don't know that he's going on vacation, but he's on his way to Tennessee with his family to do some hiking and some fun things for spring break. So that being said, if you're unfamiliar, we have had a blog in the past. Our blog used to be a monthly, and to be quite honest, sometimes we would miss a month, but it is now weekly. We're putting out blog posts weekly. So if you click into our blog, you're going to notice that there's a lot of things here. Okay. It's all education for you. That's what it's intended for. And so please take advantage of that. The podcast. So we release 2 episodes a month. And so I just want to point out to you the last 2 episodes since the last Inner Circle workshop, we've released 2 episodes, one of which was with Ed Slott. And so if you're unfamiliar with who Ed Slott is, he is kind of considered IRA's foremost, or America's foremost IRA expert. Let me get that right. Ed's got a show on PBS. He's been doing this. He's a CPA. He's been at this for almost 40 years. And so we were really excited to have him on as a guest to talk about taxes. And so you can check out that episode of our podcast. And then the other one we released, and this is the other big announcement that we have, is about Fiat becoming our own RIA. Now, that may mean almost nothing to most of you, and that is totally fine. It shouldn't. It's a really big deal for us here at Fiat. We're really excited about it. What you need to know and understand as a family that has partnered with us is that it doesn't really change a lot for you. Fiat is the same, your advisor is the same, your accounts are the same, everything's the same. But there are some things that it is going to change. We did Matt and I did a whole podcast episode on it, if you want to know more about that. And Matt also wrote a blog post on it right here. Oops, I'm lagging a little bit. I apologize there. Right here on 3/16, it got released, Becoming an RIA. And so read the blog post, listen to the podcast. We will be sending out more communications as well, but pretty exciting stuff. So anyway, check out the website. Every month, by the way, we do, let me get my little sheet here, my cheat sheet. We draw, because we would love for you to follow us on social media. And so you can do that up here: Facebook, Instagram, YouTube, LinkedIn. Follow us all over on the web. And every month we pull a random name for one of our new social media followers and give them a $20 Amazon gift card just for following us on social media. And this month, I'm happy to tell you that Krista Morgan is the winner of that $20 Amazon gift card. So congratulations, Krista. And if you're not already following us or not subscribed to our podcast, you're going to get all kinds of wonderful education from us. So I would recommend that you do that. Whew. What do we got coming up? Events. Okay, let's end here with updates and kind of housekeeping stuff. So upcoming events, Inner Circle Workshop. Just so you know, next month's Inner Circle Workshop, which you can find that information here. If you click on Inner Circle Workshops in April, it is April 27th. You can see that right here, Wednesday, April 27th. And that's going to be on inflation. This is not originally what we were planning on talking about in April, but at the end of the day, it's just a timely conversation. We've all been affected by inflation. I just went and filled my truck up with gas yesterday, and very happy to tell all of you the loan got approved before I went to the gas station. So I was able to fill my truck up with gas. Inflation's a real thing. It affects every single one of us. And so we're going to take some time to talk about kind of what's causing inflation, how to fight off inflation, kind of how to deal with this in everyday life. And so you can register for that already. The link is right here. Click on the registration button and get registered for the 27th. Okay. The other thing, if I go back, happy hours are back. Now I say this, I'm about ready to say, like, we just put the cushions back on the furniture on the rooftop patio, and we're getting excited for spring and all this stuff. And here it is in the state of Minnesota. It's snowing today. If you live not in the state of Minnesota and you're attending this workshop, just feel lucky, because it snowed here this morning. So the rooftop patio's got snow all over it, but the happy hours are starting up again. We're excited to announce that. So April, if you want to come and join us for happy hour, we'd love to have you. That's on Thursday, April 28th from 4 till 6 o'clock. We provide snacks, the drinks. Even if you just want to have a glass of water with us, we'd love to have you and just kind of rub shoulders and spend some time together in fellowship. We really value having personal relationships with our clients. If you've never heard me say this before, I'm going to soapbox here for a hot second. As a fiduciary, I do not believe that I can do what's in my client's best interests if I don't know them personally and I don't care for them. That's not part of the definition, and it's not what the SEC is after when they talk about what's in your best interest. It's all about your financials and the numbers. But at the end of the day, I think both sides matter. And so this is just a wonderful opportunity for us to get to hang out with the people that we serve. And so please join us for that happy hour. Now, housekeeping aside, let me stop sharing my screen here. We're going to jump in for the content today. And as we do that, I'm going to ask my co-host this month, Carly, if you could turn your camera on and turn your mic on so I can introduce you to everybody.
Hi, guys.
Hi, Carly. Good morning.
Yeah, good to be here. Good morning.
Yeah. So Everybody, Carly, everybody. We've got about 70 people with us this morning. So that's pretty awesome. Carly is a new friend of mine. I think we're going to become best friends. I think that's what's going to happen. Carly,
definitely with those happy hours on the schedule.
Yeah. Carly was actually, I was introduced to you, Carly, through a client of ours who thought we should meet, and they were absolutely correct. Carly is a CPA by day and a mom and wife by life, right?
Yeah, all other times. Yeah.
Yes. And so meeting other professionals that not only have high education and high aptitude, but are just wonderful people is part of what drives me in this industry. And so getting to know you here recently, Carly, it's been a lot of fun. And quite frankly, with Matt being on a trip, not a vacation, I just wanted to replace him with somebody that knew more about taxes anyway and was a little, a little easier on the eyes. So we're extremely happy to have you here, and everybody else will be as well. And so, Carly, thanks for joining us. Before we jump in, we know you're a CPA. I said that you're a mom. Tell us a little bit about your family and give us a fun fact about you before we get to our quiz.
Okay. Well, I actually have 3 kids, 14, 4, and 1. And we like to say we're in all ages and stages. We also sometimes wonder why we started over, because we're 4 years away from that 14-year-old being out of the house, and we're doing it all over again. But it is fun and busy, right? With the 14-year-old, we are fully in the chauffeur stage of all of his sports and activities. And then the 4 and the 1-year-olds are just, they kind of run us ragged, right? As toddlers do. So that's really that's the big part of my life. But for career and things I really love, I think probably the fun fact to know about me is that I'm from Oregon. So I was born there. I moved here about 7 years ago, 7 years in May. Okay. So I'm a transplant, and I love being outside. And I think part of that is that Oregonian lifestyle. You've got mountains and beach and oceans, and kind of any way that you can get outside, you do. And I love that about Minnesota too. That's actually pretty true here as well. The geography looks a little different, but I love that the people here love to be outside. I love that lake life in the summer too.
I know this isn't exactly true, but I'm going to go with kind of the broad brush. What a great career for you to pick if you love being outside and you live in Minnesota, because you don't really want to be outside in Minnesota January through April anyway, right? Yeah. And so when your life slows down, you get to go take advantage of it when the 3 months that we have that are actually awesome here.
I know. I've been asked a lot if I'm a skier, and it's really hard to have a winter sport when you're a CPA. It's just not really the time to pick up a hobby, but I do get to enjoy all the rest of the year. So.
Well, there you go. Well, awesome. As Carly, I filled in a little bit. We're gonna take advantage of our fun and friendly quiz. And to all the participants, I just want to remind you one more time. It's okay to get these questions wrong. Some of them are meant for you to get them wrong. Nobody's going to know what you answered. This is not going to be personally graded or anything else like that. We're going to look at this on an entire workshop level. But what we are going to do is we're going to take a really quick, fun and friendly quiz. And as the quiz is playing, I'm going to play some music in the background. You'll have about 3, 4, 5 minutes to take the quiz. I'll kind of monitor how long it's taking everybody to get through it. And then after that, we're just going to discuss all of the questions and go through the correct answers and kind of give you why they are the correct answers. And like I said, at the end of this workshop, my hope is that we have time for a Q&A where you can ask the tax expert, which is not me, that'd be Carly, any question that you want to ask, and we'll do the best that we can to answer. In fact, I'm going to incentivize you to ask questions, because a lot of people have questions. They're just a little shy about asking them. So here's the incentive. I've got some giveaways. And so if you ask a question that we choose to answer, I'm going to send you something, and you get to pick. You either get to pick, I'm going to Van and White for a second. We have these wonderful, this is a candle. Okay. It's a Fiat candle. It's got kind of a Northwood smell, kind of matches the whole Minnesota theme, right? So we've got a candle. You can pick a candle. We have a hat. So these are the Fiat hats. I wear my Fiat hat all the time. In fact, I had mine on yesterday. I love mine. We also have a polo shirt. Now you just have to send us your size, but we have Fiat polo shirts. These are Travis Matthew. If you're a golfer, you understand what that means. They're nice. And lastly, I have a book written by Ed Slott. This was Ed Slott's the guy I was talking about earlier, who's on our podcast. He's a CPA, lives in New York, does a lot of planning around this idea of future taxes and how to, for retirees to take advantage of tax planning. And so he came out with a book last year called The New Retirement Savings Time Bomb. If you want a free copy of that book, we've got copies of them here. We can send that as well. And so there you go. Ask questions. You're going to get free stuff just for asking questions. And Carly and I are going to do the best that we can to not talk our faces off for the next now 45 minutes so we can actually get to some of these. So here comes the quiz. Carly, we'll just mute and take our cameras away and let them take the quiz, and we'll go from there.
Great.
All right, about 30 more seconds to finish up, everybody. All right, 5-second warning as I come back on screen here. 3, 2, 1. Most of you got all the way through that. Nice work. End poll. Carly, if you could come back with me. There you are. Perfect. We're going to end the poll. Which, by the way, Carly, I should just tell you this. I said that one of our clients or family members here at Fiat is the one that introduced us. They're here today.
I happened to notice that. I was looking at the participant list while we were in the quiz. So hi, Tom. Yeah.
Anyway, so that said, let's just dive right in. So the first question, I'm going to share the results here. Everybody should be able to see the results to these questions on the screen. Carly, can you see them?
I can see them.
Perfect. So let's just dive right in. Question number one, according to the Tax Foundation, if all tax statutes, regulations, and case law were printed out, which why would we have all three? Because at the end of the day, you really got to know all of that to really fully understand tax code, right? Not just statutes. You got to know the regulations and case law around it. How many pages would it be? So nobody said A, or option number one, 2,600 pages. 42% of you said 77,000 pages. A couple of you said 17,400 pages. And then 51% of you, the winner, at least as far as your answers are concerned, is 39,000 pages. The correct answer is actually 77,000 pages. Now, qualification, this is assuming 450 words per page, standard sheet of paper, 12-point font, all that kind of stuff. But that's a lot. That's
just some light bedtime reading.
Yeah. Now, Carly, if you could just give us the difference between statutes, regulations, and case law, and kind of how that all fits together.
Yeah. So when we are looking at those, first, you should know that there's kind of an order to their significance, right? So tax statutes are the laws as they're enacted. But if anyone's tried to read tax law before, it's not always very clear. And so then we look at regulations are the IRS kind of interpretation of what that statute means, because that statute came from Congress. Then the regulations help to kind of clarify that even more. And then people file tax returns using their understanding of those tax statutes and regulations, and it gets challenged. Yeah. And that can go all the way up through the court system. And then we look at case law for how a judge evaluated those specific cases to determine even more clarification on what those statutes really mean. And so it's then really our legal system interpreting the tax statutes and the regulations even further and applying them to more specific facts and circumstances to help us to understand really how to apply them. It's super complicated. It's pretty amazing to think that we're supposed to figure out how to file our taxes using these 77,000 pages.
The way I look at it is like when you're a parent, like you're co-parenting, right? It's you and your spouse. You're trying to co-parent your kids, and you lay down the law, right? And you're like, hey, this is the deal. You get this much electronic time, or this is the grades we expect of you, or this is your bedtime. And then just between the two of you, sometimes there's this massive misunderstanding of what the law was, or your kids don't understand what you meant by whatever law you put down. And here we're trying to regulate an entire tax code and system for millions, hundreds of millions of people. And so you end up with these iterations of, okay, we're going to write it down, but then we're going to tell you what we meant when we wrote it down. And then even after that, we end up with these cases that end up sometimes at the Supreme Court level trying to challenge what even the additional regulations meant per the statutes. And so I can just tell you personally that in my studies of trying to understand taxes, especially as it relates to retirees, a lot of these cases come into play when it comes to IRAs and the movement of IRAs and rollovers versus direct transfers and the taxation at death. And there's been a lot of case law, which is kind of that third iteration, just around how all this stuff is supposed to play out. And so when you get a big piece of legislation that was passed, as an example, the Secure Act back in 2020, which had a massive impact on how you can leave money, and it took away this stretch IRA provision. Right. I'm just waiting for case law, right, to get down to the point where people start challenging exactly what they meant, because it was a statute that they put out, and then now we're going to get down to the point where it can be challenged. But the bottom line is it's a lot of pages. There's a lot to understand. And I read a stat when I was preparing for this today, Carly, that I thought was mind-blowing, mind-boggling. From 2000 to 2012, there were over 4,000 updates to statutes and regulations in the tax law. Now, if you're quick with math, you'll realize it's about an average of one a day. One a day. So how you keep up with all this stuff and do what you do for clients is unbelievable, because it's constantly changing, which is why it's 77,000 pages long. In fact, this is a little fun. I'm going to share another screen here with everybody because this is kind of fun to look at. Not that one. Where to go? This one. Here we go. Can you see that? You see the red graph? That is the number of pages if printed out over time. And so you can now understand between us writing the statutes and then coming up with the regulations for those statutes and then the case law surrounding it, how complex this has gotten over time. Kind of crazy. Anyway, next question. Question number 2 for the poll. All right. The United States tax code operates on a voluntary tax system. Can you still see that? The poll results?
Yeah.
Okay. True or false? 35% of true, 65% of you said false. I'm going to put you on the spot here. What's the correct answer, Carly?
It's true. And it's funny, every time I see that question, what I picture, if you're movie buffs, Hunger Games, where she volunteers as tribute, that's what I picture. Like, who's volunteering in this
Yeah,
scenario?
exactly. Right.
Yeah.
So what we mean by that, though, isn't that you just get to opt in and out of taxes.
Right.
So what does that mean that we're in a voluntary tax code?
So in a voluntary tax system, when you file your tax return, are actually telling the IRS how much you owe. And it might not feel like you've told them what you owe because you've been paying taxes in, but that's because the IRS has learned that people aren't going to save their money and pay their taxes at the end of the year. So they're more likely to volunteer if they've been taking taxes out all along to potentially reconcile what you've paid throughout the year with what you actually owed. Interestingly, the IRS can still tell you that you're wrong, and then you're on the hook for the difference and the penalties.
Right.
But they're really saying it's up to you to tell them how much money you made and what the tax liability is on that income.
You know, what's interesting about that, Carly, is we hear, I'm sure you get this more than I do, but you hear people say all the time, like, oh, I got a tax refund, and they maybe point to their accountant and they're like, oh, they're geniuses. I got $5,000 back. Or they ended up having to pay taxes in, and the opposite happens where they look at their accountant, their CPA, and they're like, I don't think I have a very good CPA because I owed $5,000 at the end of the year or something to that effect. But the bottom line is you owe what you owe. Right. It just is what it is. And it may be such that you overpaid throughout the year. And so at the end of the year, they owe you money because you just overpaid the bill. Or it could be such that you underpaid the bill, and so you have to pay in at the end of the year, but your bill is your bill. As a CPA, where you can affect change is helping them file correctly, taking advantage of things like deductions and exemptions and credits inside of the tax code, or maybe if they're business owners, affecting some change in how they run their business on a tax basis, or as retirees, where we would come in as helping them create a paycheck and pulling from the right types of accounts to create as efficient of a paycheck as possible. And so throughout the year, there are ways to affect change relative to your taxes. But by the time December 31st hits and the clock strikes midnight, we all turn into pumpkins, and there's nothing that you can do about it or I can do about it. The bill is going to be what the bill is. You just have to reconcile with the IRS and say, okay, this is what I paid you throughout the year, but now that I filed, I realize I overpaid you. So now you owe me money back.
Yeah.
Right.
And, Brad, I know you do a lot of planning with your families. And I think that's really what a good CPA can do, because you're right. Once we get to the end of the year, there's really very little we can do after the end of the year to affect change to what that tax bill is going to be. So to me, a good CPA is really proactive in planning, gets you actually as close to zero, not a refund, but not owing. Right. And helps you evaluate kind of the timing of when you take income and what that income is that you take that is taxable or may not be, depending on the source. Right. That helps you to kind of choose and evaluate the timing of that income to keep you in the best tax bracket or to optimize your tax bracket over time.
Yeah. It's so in your working years, it's easy because if you're W-2, they're just pulling taxes out as you go, and you fill out a form that kind of is supposed to help estimate what they should be pulling. That doesn't mean it's going to be right.
That's actually one of the bigger questions I get. I feel like I'm shopping at the grocery store and someone says like, what should I put for my exemptions on my W-4 at my job, and there's so many ways to answer that question. Are you married? Do you have kids? What are your dependents? Does your spouse work? Do you own your home? right?
Yeah.
Are you taking the standard deduction? All of those things. So it's really hard to gauge that.
Yeah.
Interestingly,
Is
the
there a
IRS
big
now
gap
has a new
between income
tool.
between you and your spouse? Because I've seen that
Right.
cause big problems.
Right.
A lot can be wrong. It's all an estimate. And you want it,
Yes.
to your point, you want to try to get as close as possible. That's where that proactive planning comes in. So you don't have any surprises at the end of the year. Because at the end of the day, it's okay to owe them some money. They don't want you to owe them too much, or they're going to penalize you. We're going to talk about that. But it's also okay to get the money back. But why would you want to give the government an interest-free loan all throughout the year and kind of give them your money that's you didn't owe them in the first place? And so it's interesting because the IRS knows that they're not going to be perfect. And they know that not every American is going to pay whatever their fair share is, that they're not going to get it right. The IRS's version of success is to get 90% of people into the right bill. Like they've come out and said that in the past, that as long as we're an A- student and we get a 90%, we're going to call that good. But that's where audits come in and things like that, is because they're just kind of checking your work and making sure as a volunteer to file your own taxes, and the onus is on you to tell the government what you owe them. They want to make sure you got it right. But that's, again, where the help of a professional can come in. All right.
And that's why you get W-2s and 1099s at the end of the year. The IRS wants you to know that, hey, someone reported to us that you received this income. So now we expect to see that income on your tax return, and those numbers should match, right? So that's the whole reason that we do that. And in fact, when I worked with Tom at the bank, that was one of the big pieces of work that I did for the bank, was helping them to properly report income on 1099s to all of their customers.
So somebody told on you and told us that you had income.
Yeah.
Now you have to pay.
Yes.
All right. Question number 3, the Tax Cuts and Job Act affects my taxes. A, while I'm alive. B, after I die. C, both. And D, neither. The vast majority of you answered both. And I'm happy to tell you that I think this is the first question out of the 3 that the majority of you got it right. The answer is both. And so let's talk about that a little bit, because there are provisions, Carly, that affect the average person. There's a lot of provisions on the corporate side of it, you know, for the Tax Cuts and Job Act, but there's a lot of provisions on the personal side as well. Maybe just talk about a couple of things that it changed for us while we're alive, and then we'll go to how it might affect us at death.
Sure. I mean, I think the big one that at least is in the news a lot, and what we see people fighting in Congress about, is the SALT caps. So on the individual side, we used
especially in Minnesota.
Minnesota's a rough state for it. Yeah. We used to be able to write off the state taxes that we pay. And with tax reform in 2017, that changed to a cap of $10,000 per year. Interestingly, that's $10,000 whether or not you're single or married filing jointly. So it actually kind of hurts you. It's one of the ones that works against you when you're filing jointly, is that $10,000 cap. So there's been a lot of push to change that. There have been workarounds for small business owners and some ways to kind of work outside of that cap, but that was a huge deduction that we kind of lost. But then in contrast to that, we raised our standard deduction limit. So we used to get about $12,000 as a standard deduction. And when you filed your return, you could optimize between your itemized deductions, your medical, your mortgage interest, real estate taxes, income taxes, and charitable contributions, or that $12,000 standard deduction limit. You could kind of pick between the two. And with the TCJA, they increased that limit to about 25K. It goes up every year a little bit for inflation, but if we just kind of say around 25K for ease of numbers, most people now kind of fall in that standard deduction bucket because they can't write off the more than 10K of state income taxes. And so when they add up all of their other deductions, they don't hit over that 25K limit. So that was a huge one that kind of swung things for a lot of people, where the benefit of owning your own home, the benefit of maybe charitable contributions that you're making don't matter as much. So then there's some play that we can do in, you know, the timing of when you make your charitable contributions, and maybe grouping charitable contributions and bulking them into 1 year so that they hit you over that 25K cap and give you some benefit. But it's definitely made an interesting change on the individual side. I think in some ways it makes things simpler. If you're just taking a standard deduction, there's less work you have to do to put your receipts together.
That's definitely how they sold it, right?
Yes.
Was simplicity in a lot of ways. But now we have people on the workshop today, and we work with families all over the country, and we have people that don't live in the state of Minnesota. Obviously, we talk a lot about Minnesota because we're domiciled here at Fiat, but the SALT deduction is not as painful, obviously, if you live in a state where you don't pay state taxes. Right. I can help you move there if you want to learn more about that. But yeah, there's a lot of changes. And the bottom line is we just got to be cognizant of those changes. Also, because this Tax Cuts and Jobs Act, interestingly enough, one of the biggest pieces of legislation that's passed in the last 3 decades isn't permanent, at least on the personal tax side, right? And so everything that changed, and we're just going to kind of get used to it and kind of get into this new flow of the way things work, and then it's all going to go away. And at the end of 2025 and in 2026, we're going to go back to the law as we knew it in 2017. And so we just got to be cognizant of that. But speaking of the after you die, how can it affect you? What did the Tax Cuts and Jobs Act do for us at death?
That actually was a huge benefit to taxpayers in that it temporarily, because right now it's slated to reverse, but it increased the estate tax limit to over $11 million now for a married couple. So that's a huge threshold increase and for those of you who don't know, the value of your estate, the value of all of your assets when you pass away are taxable, assuming that they exceed a certain limit, right? And in general, we used to just say like a $1 million limit, but this has started to increase that limit. So it's changed your ability to pass on wealth to the next generation and to your heirs without having there be a huge tax hit. And I think we're probably going to talk on tax brackets going forward. But the other thing to kind of note about the estate tax is that there are less tax brackets when we're talking about estate taxes, and they jump a lot faster than when we're looking at filing individual or personal tax returns when you're alive. So the tax hit grows much more exponentially, I guess I should say, than on the individual side when you're looking at the income that you make as you're alive. Yeah.
So the bottom line is, just to clarify again, we're not talking about ordinary income taxes. We're not talking about the taxes you pay on your income as you earn it, or IRA distributions or things like that. We're talking about estate taxes. It's a whole different set of taxes that you may have to pay if your state's too big, right? Everybody gets an exemption. You get like a free pile that you get to pass on without having to pay those estate taxes. And to your point, prior to the Tax Cuts and Jobs Act, the exemption was much less. Today, it's 11.4 million per person. And so as a married couple, you can have almost a $24 million estate if set up correctly, pass on without these estate taxes. Now, what that doesn't mean, and I want to be clear here, if you have an IRA of $1 million, it doesn't mean that $1 million IRA is going to your beneficiaries non-taxed. It's still going to have to pay the ordinary income taxes due on that because it's a pre-tax account, but you won't have to pay these additional estate taxes. And so when the Tax Cuts and Jobs Act expires, that exemption is going to go back down significantly. And there's been more discussion about even bringing it lower. It's a way to try to raise more money from a congressional standpoint. We don't have time to get into all that hyperbolic discussion, but the bottom line is it affects you both while you're alive and possibly when you pass on. It's been kind of the running joke that if you're ultra wealthy, you should die before 2026 because it's going to benefit your family, not you if you pass away, but your family. Question number 4, safe harbor rules dictate how much. This is a very nerdy question. Safe harbor rules dictate how much tax you have to pay throughout the year to avoid penalty. Which of the following options is not a safe harbor guideline? A, owing less than $1,000 in taxes for the year. B, making a lump sum true up payment on your fourth quarter estimate. C, paying at least 90% of the tax owed for the year or at least 100% of last year. Or D, if your AGI is over 150 married filing joint, or 100% for you have to pay 110% for the last year. So which one of these is not the correct guideline? So there's 3 of them that are correct. Carly, which one's not correct?
It was pretty close out there in the poll, but it's actually the second, that paying that fourth quarter true up. So you are required to pay your estimates in evenly across the year. There are some small exemptions where you could potentially annualize income, but in general, you have to pay your estimates evenly across the year. And so if you make a big lump payment at the end of the year to kind of catch up for what you didn't pay at the beginning of the year, you still are liable for those penalties. And interestingly, if you overpay, that does not work in the reverse, right?
You don't get to penalize the IRS for taking too much. Yeah.
No, it does not work that way.
So the reason I asked this question, the reason this is a good conversation for you and I to have and for people to hear is because a lot of people when they retire come out of W-2 jobs, right?
Mhm.
And as you're paying taxes through your income throughout the year, that just becomes an automated process, and it's kind of mindless in a good way. Like you just don't have to think too much about it.
Sure.
And then you get to retirement, and yes, you have Social Security, maybe you have a pension, maybe you're taking distributions out of an after-tax account or Roths or traditional IRAs or whatever you're doing.
Mhm.
But that becomes much more complicated because there isn't automatic taxes being withheld, and you're not filling out a W-4 and things of that nature. And so the onus is on you, because it's a voluntary tax code, to figure out, as this money is dripping out to you, once a month or however often you're paying yourself and taking distributions,
Mhm.
the onus is on you to pay as you go. Now, the IRS, what I've been told, and Carly, correct me if I'm wrong, is the IRS would love it if you paid the tax bill immediately for every dollar you took out. That would be their ideal.
Sure.
But they will allow you, because they're so kind, to just pay once a quarter and true up with them once a quarter. But if you took out a bunch of money in Q1 and then tried to pay that bill in Q3, they don't allow that. And so they kind of, to your point, they want you to pay as you go. And so as you're recreating a paycheck for yourself in retirement, these quarterly estimates become awfully important. And usually a lot of times how people are looking at structuring their tax payments in retirement.
Right. Yeah. I mean,
I think I said out of line there.
No, I was just thinking that for human nature's sake, I get why the IRS made this rule, right? Like they are saying, we want you to pay in your tax while you have the money to do so.
Yep.
And that we are likely to spend it if we don't pay it in. And
Yep.
so their best chance of collecting that tax is if we pay it in as we go.
Yep.
If
Yep.
it's after the end of the year and they have to come after you for it, it's gonna be very unlikely that they can get that money just because people spend their money.
Yeah. Yeah. So the bottom line is there is a rule around how much you have to pay in the coming year and what your estimate should look like. It's based on a safe harbor calculation. There's different ways that they calculate that. You just gotta be cognizant of that so that you set up the right estimates. You don't get to the end of the year, not only have to true up and pay in what you owe, but maybe possibly pay a penalty on top of it. All right. Question number 5. Roth conversions are a good idea no matter where taxes go in the future. A, true. B, false. C, why did I sign up for a workshop on taxes? I can't believe some of you answered that. The answer here is false. It's hard to say ever that anything makes sense for everybody. Okay. And so very quickly, because it's already 11:43, what I want to do is I just want to share with you very quickly a fun little exercise I like to walk through with people. You should be able to see a little PowerPoint. Can you see that, Carly?
Mm-hmm.
Okay. And so we get this question all the time. Do Roth conversions make sense, and where do they make sense, and why do they make sense, or where do they not make sense? And so quick exercise, if you have $100,000 in an IRA and we're having this conversation converting it to a Roth IRA, can you do that? First and foremost, yes. It's the Wild West right now. Anybody can convert at any time, as much as they want, whenever they want. There's no income limits. There's no limits or thresholds on how much you can convert. Congress, again, is talking about possibly changing that, but it hasn't happened yet. And so right now, it's a Wild West. Do whatever you want, however you feel. Doesn't mean it's a good idea, okay? Just means you can, right? So $100,000 in an IRA. If I choose to convert that to a Roth IRA, I got to pay my taxes on the way over there. Right? Roth IRA is an after-tax account that grows tax-free. So should I pay off the IRS today is the question, or should I wait to pay them off later? Pretty simple question. Well, in my example, our tax rate's 25%. That makes my math simple and makes the concept simple. Okay. So if I pay the tax bill, if I convert, there we go. If I do the conversion and I pay the bill, I'm going to deposit $75,000 in my Roth IRA. So to figure out if this was a good idea or a bad idea, let's fast forward. And let's assume that the IRA and the Roth IRA are invested exactly the same, Carly. And let's also assume that we deferred both of those accounts for 10 years. And in that 10-year period, we did okay. We doubled our money. So the 100, if I would have stayed in the IRA, the 100 goes to 200. If I would have done the Roth IRA instead, my 75 turns into 150. Now, for math whizzes out there, that's a 7.2% annual rate of return. That's what you need to double your money every 10 years. And so that happens. So at first blush, you look at this and you go, okay, 10 years ago, the balance was a $25,000 difference. Now, 10 years later, it's a $50,000 difference. Mm-hmm. And this is where the people that champion the superior cause of tax deferral go, look, see, if 100 cents of your dollar gets to stay invested, then all 100 cents gets to grow. And that's why we have this larger chasm 10 years later of $50,000 in account value. If I convert to Roth now, only 75% of my money gets to grow, and I'm going to end up with less money. Now, any good scientific experiment only has one variable. So we're going to keep taxes the same. So let's say 10 years later, you go to spend this money. Your taxes are exactly the same as they were 10 years ago, 25%. Because it's not about how much money you have. It's about how much money you get to keep, right? Because IRA is a little misleading. IRA stands for individual retirement account, when in reality, you kind of jointly own that account with the IRS. Part of that money is yours and part of it's theirs, right? You owe taxes on it. So let's take the taxes out of the Roth, take the taxes out of the IRA. If taxes stay exactly the same, your money that you get to keep and spend on your fun and lifestyle or give away for somebody else and their fun and lifestyle is exactly the same, $150,000. And so we get this question a lot. Does it make sense to convert? Does it not make sense to convert? It really, really, really depends. We've got some clients, Carly, that we're converting at very high rates. And we've got some clients, we've told them not to do it because it doesn't make sense for them and their family. But the bottom line is you just need to make sure that you understand conceptually, if I choose to put money away on a pre-tax basis, I'm making a very simple bet. I'm betting my tax rates are going to be lower in the future than they are today. So I'm not going to pay you today. I'm going to pay you at some point in the future. If I put money in a Roth IRA, I'm making a bet. I think my tax rates are going down. And so I'm going to pay you today so that I don't have to pay you in the future. Both could be wrong.
Right. And we talked about this a little bit, that you're looking at it actually in two ways. One is that maybe tax rates overall, from legislation, are going down, but also maybe tax rates are just going down because your income is different in the future. And so you fall into a different tax bracket. So the rates could stay the same, but all of a sudden you're at a different income threshold. So there's kind of two different things you have to evaluate when you're planning long-term about, how much you should have in pre-tax versus post-tax retirement. Yeah.
Yeah. It's a tough question. And I think it's kind of like the question of, well, Brad, what should my portfolio look like? And how well diversified should I be? And what should I invest in? Well, if I knew where the market was going to go, I would tell you to put all of your eggs in one basket. I would be like, well, based on this, we should go all Bitcoin, or we should go all Apple stock, or we should go all small cap, small cap emerging markets, whatever. If I knew where taxes were going to go, I'd be able to say, well, yeah, go all pre-tax, or go all after tax, or go all tax-free. We don't. And so just like a portfolio of investments, you should be diversified. You should have money in different buckets so that as Congress makes changes, and they do, remember from 2000 to 2012, on average, one a day, that you have the flexibility and you bring the control back to yourself, because that's really what diversification does, is it gives you more control. And that's really what matters in this scenario. So, all right, let me, next question. Qualified charitable distributions, I love this question, are allowed starting at what age? A, 70 and a half, 59 and a half, 39% of you said that was the winner as far as the answers are concerned, or 72 or 65. Kind of a trick question, in my opinion, because they just changed. QCDs used to overlap from an age perspective with required minimum distributions, but they don't anymore. So the correct answer is, I'm going to throw it to you, Carly.
Well, first, should we actually ask if people know what a QCD is? Do we need to describe that first?
Okay,
I actually
fine.
thought that
Okay,
reading
fine.
this question, like, are we covering what a QCD is on this call?
Go for it.
Okay, so you just mentioned required minimum distributions. Part of your IRA growing is that once you hit retirement age, you actually have to start, and you're required to take money out. And that's actually a calculation based on the total value of your IRAs at the end of the prior year. And so that is taxable income to you if it's in a traditional IRA, and that's been growing, when you put money in pre-tax. So when you take it out, you pay tax. So one way that you can work around that is taking that money out and giving it directly to a 501c3, giving it directly to a nonprofit organization. And so that money meets the RMD requirements, but it does not come into income on your return.
Yep.
So you also can't double dip. You also then don't get it as a charitable contribution, but you just don't pick up the income. So you have to make sure I've definitely seen that error on a return before, where someone excluded it from income and also took a charitable contribution for this large amount that they distributed.
Wouldn't that be nice?
Yeah, right? No, the IRS isn't that nice, but they do allow you to put money somewhere to support an organization that you really value.
Yep.
And especially if you don't need that to live, and maybe it's going to create, it's going to hurt you in terms of the tax bracket that it puts you in, or it jumps you higher, makes your Social Security income more taxable. So you can maybe strategize in a way to support a cause you believe in, and also avoid kind of this big tax hit because it jumps you into a higher tax bracket when you take those RMDs. And I think the right answer is 59.5.
For qualified charitable distributions, it's still the old RMD age of 70.5.
Oh, it's still the 70.5.
It is. They didn't move it. So RMDs are now 72. They changed that, but they didn't change the QCD age. They stuck that at 70.5. That said, just to reiterate, so everybody understands, if you want to give money to charity, we all know that you get a tax write-off, right? But if you're in your working years like I am, and I want to give money to charity, that doesn't start mattering to me. Now, hopefully the number one reason you're giving to charity isn't a tax deduction. Let's just get that out of the way. But it is nice to get it. But if you're working like me, until you get through that standard deduction, it really doesn't do anything for you until your itemized deductions become more than your standard deduction. So it could be possible that you gave a $500 check to somebody or a $1,000 check to somebody, and you actually don't get any benefit from it because it doesn't exceed your standard deduction, right? Whereas a QCD, you can take the standard deduction, give that $500 to charity, and it matters immediately. Right. And so QCDs are really powerful in that way, that you can kind of double dip because you get the standard deduction and you get to do the QCD kind of.
Yeah, that's if you weren't itemizing to begin with. Yeah.
It makes taxes taste a little bit better.
Absolutely.
And number two, it's the way to take money directly from an IRA, satisfy the RMD. It can't touch your bank account, has to go direct to the charity, but you get to kind of double dip again, where it's an RMD satisfaction for you, and it's that above the line deduction from a charitable standpoint. And so they're a really big part of planning for anybody that, one, has IRAs, or two, has any inclination at all to ever whatsoever give money to any nonprofit organization. I don't care if it's a humane society or your local church or the Red Cross or whatever it is that you value in your life. It is a wonderful opportunity and a tool that everybody should be utilizing, in my opinion, should you want to be giving to charity. Side note, and I would love to talk more about this at some point, Carly, but we have questions coming in and I want to get through the rest of this workshop, but there are other ways to give, right? And there's, before we planned on talking through like annual gifting limits and how much you can give away every year without hitting your exclusion rates. I guess we're going to have to punt on that because we're running out of time. We're just having too much fun talking about taxes. Who would have ever thought we would say that?
No one else thought that we were going to have an hour's worth of content.
Right. QCDs, if you're unfamiliar, you need to be familiar. If you have questions, let us know. We would love to answer your questions. Question number 7, my Social Security payment went down. How is that possible? Answer all that apply. So 30% of you answered taxes, 46% of you answered income related monthly adjustment amount. Boy, is that a mouthful, which is why they've acronymed it to IRMA. 39% of you said your income was too high, and 21% of you actually said that's not possible. The answer, and it's a multiple choice, right? You can answer all 3 of the first things are reasons why your Social Security payment could go down. So maybe a trick question. It doesn't go down because your total payment amount went down, right? If you're getting $1,500 gross a month, that isn't going to go down. But I get this all the time. And I put this question in there because I just got it recently a couple of times from people saying, Brad, my Social Security went down. Why did my Social Security go down? The gross payment didn't go down. But netting out of your Social Security is your Medicare, first and foremost. For most people, they have their Medicare Part B premiums, and for some Part D as well, if they have a premium associated, coming directly out of their Social Security payment. And unless you have not turned the news on in the last 6 months, you'll know that they increase Medicare premiums, and frankly, quite significantly. Last year, base rates for Medicare Part B were $148.50, $148.50 a month. They're now $170.10 or something like that, $170.10. So they went up quite significantly. So you're going to see that reduction. It could also be which was, let me go back there, taxes. So if you're having a percentage of taxes being withheld. It could be that based on your income amounts, that could be different. And so you're having more taxes withheld. We all got a 5.9% increase in Social Security this year. That means your payment got bigger, which means your tax bill is going to look bigger. And so that could be a reason why. Another one is your earned income was too high. So if you're one of those people that filed prior to the age of 60, your full retirement age, which depending on when you were born could be 66, it could be 67 or somewhere in between, 66 and some months. If you filed prior to that and you filed early and you're not yet full retirement age. So as an example, let's say you're 63 and you filed for Social Security, but you're still working. You got a part-time job. If your income is too high, they will start to claw back your Social Security. And there's a whole set of rules of what happens to that money that they claw back, because you do end up getting it back over time later in life. Don't have time to get into all of that. But if your Social Security looks different, you did not take a pay cut. That's what I want you to understand. Your gross amount's still the same, but what is deducted out of that and how they factor that could be why your Social Security looks different. So if you have questions ever on, hey, Brad, why is my Social Security different than my expectations or something to that effect, just let us know. It could be based on, and then the last one was IRMA, I guess. I didn't even get into, other than the fact that your Medicare base rates just changed. It could be your Medicare premium income adjusted. That's what IRMA stands, that income related monthly adjustment. If your income starts to exceed certain thresholds, Carly, you could probably speak to this better than I can, your Medicare premiums are going to go up.
Yeah, I mean, they've set those premiums based on what they believe you can afford based on your income. And so if that income changes, then your premium changes as well. It's very similar to like the premium tax credit in the marketplace. If you're getting your health insurance through the marketplace, you can get a tax credit that helps to reduce those premiums. But if your income goes up from what you originally told them you were going to make, then you have to pay some of that credit back. So it's a very similar mechanics for how that works with Social Security and Medicare.
Yeah. Okay, question number 8. The U.S. has set new records for debt to income as a country over the last 2 years. What was our debt to income, or our income is GDP, gross domestic product, at the end of 2021? 21% of you said 87%, 33% of you said 108%, 12% of you said 31%, and another 33% of you said 137%. So we have a tie for first place. And so one of the correct answer is one of the tied answers, and that is 137% is kind of where we stand today. And here's why I bring this up, because I don't want to be like Chicken Little, sky is falling. Like it's not that. I can't predict where taxes are going to go in the future. But it is interesting to note, because at the end of the day, if we have a bill, and if it's just like you and I, Carly, if you make $100,000 a year and you're spending $137,000 a year, something has to give. Right. At some point you either need to make more money or you need to raise more money to be able to pay debt. Right. And that's really the two options that the Federal Reserve has, is they can print more money, which they've been doing quite extensively, or they can raise more money. And when they raise more money, that either comes from corporations or that comes from you and I. And so it's not to say that I'm guaranteeing tax rates are going to go up in the future or that they're going to skyrocket in the future or anything like that. But as Mark Twain has said, history may not repeat itself, but it definitely rhymes. And so when you start thinking about this idea of tax diversification as a retiree and having your money in different tax buckets, this is just another reason to take a peek at that. I do have an interesting graph I want to show everybody, because this is just kind of fun.
I was going to say, that's part of why the TCJA reverses, right? Yeah. Is that to balance this budget and to get the bill to pass, we had to reverse it, because if we left these lower tax rates for corporations and individuals in play indefinitely, we would lose money and we'd go further into debt. So that's part of why the TCJA
absolutely
goes back to where it was before in 2025, 2026.
Before I share my infographic here, it's 11:59. We do have a lot of questions. We're going to get done right at noon before any Q&A. Carly, do you have 10 minutes to stay back and do
I was going to say, I have some extra time and I'm happy to stay.
For those of you on the workshop, if you need to leave at noon, we get it. I apologize, we didn't get to some of your questions. We have all of your questions recorded. And so if we don't get to your question specifically, Carly and I will do the best we can to get back to you through email or some other form to make sure your questions get answered. But the infograph you see on your screen here is looking at that debt to GDP or debt to income of almost every country out there. There are some that do not report to the IMF. But the bottom line is we're not the worst. And this infographic is now a little bit old. You can see here the US, if you're trying to find them, they're right here. And so this was before the end. This was like third quarter of 2021. We were at 133. We ended the year at 137. So it is a little bit old. As you can see there, Japan is leading the way. That's been true for a very, very long time. If you know the history of Japan and their economy, they've been at 0% rates for over 3 decades and been kind of stuck in this rut and this mutt, and have a lot of debt. When you think about equities and stock markets, that's an equity position. Bonds are a debt position. And when you think about equity markets, the United States makes up 54 cents of every dollar invested in equity markets across the planet. We have the biggest equity markets, and it's not even close. Japan, biggest debt market. They have more bonds than anybody else does. And so that kind of fits the narrative of what you see here on the screen. The bottom line is we don't want to be at prolonged debt levels of this magnitude it's just not good for the economy. It kind of slows the economy quite significantly over time. And so interesting to note, one more infographic I'll share here, because they've been monitoring this since 1940, kind of this debt to income level. And this is what it looks like. The lowest it's ever been is 31%, which is why I gave that answer, is in 1981. We also happen to have really good tax rates in by the end of the 1980s, our top tax rate was 28%. Because through the 80s, there were 6 major tax reforms that got us down there. But in 1981, we had the lowest. We had 31% debt to income. And obviously, you can see there back when they started tracking it, Carly, it coincides with the war. We had a really big war that we got funded. And so we brought on a lot of debt to make that happen. And then for a long time, it fell. And then we've been kind of on this uptick. And as you can see there on the infographic, it's kind of spiked here a little bit with this pandemic that we've had going on recently. So last question. And Carly, I didn't give you the answer to this question, so I'm gonna see if you get it right. The latest measurable snowfall in Minnesota, not just in the Twin Cities, was 1.5 inches on what date? 25% of you said June 4th. 26% of you said my birthday, May 31st. 11% of you said April 29th. 19% May 24th, and the other 19% of you got the correct answer. This is a very depressing question.
Yeah.
I put this in there because it snowed this morning. You got to be kidding me. What is your guess, Carly?
Okay, so I moved here 7 years ago, and the latest that it's been where there's been snow since I moved here was April. Actually, in COVID, we had snow. Okay. I just remember because the tax deadline kind of passed. There was an extension, but April 15th passed. And normally I'm like, woohoo, we're done. Yeah. And instead there was snow, and kind of on top of like all the kids being home and we can't go anywhere, it really felt like salt in the wound. So I don't know. I'm not ready to answer, like emotionally, I just can't answer anything later than April 29th. I think that's where we're at.
June 4th. The answer is June 4th. June 4th of 1935. It snowed an inch and a half. Now, obviously that's northern Minnesota, and a little bit different climate in northern Minnesota than it is down here in the Twin Cities. But March is, we get so spoiled. It was 60 something degrees here on Monday, and it's snowing today. So if you don't live in Minnesota and you're not from the state of Minnesota, and your family we've worked with, but you've never even been here before, I guess good on you from a weather perspective. There's a lot of wonderful things about Minnesota, don't get me wrong, but weather is not one of them. Perfect. We've come to the end of our content. There are a lot of questions, Carly. We're going to stick around and try to let's kind of like try to lightning around some of these questions and get through as many of them as we can. I saw one in here earlier I wanted to get to. Somebody asked, yes, is there any downside to converting all IRA money to Roth IRA over time? Generally speaking, and I'll take this one really quick, the answer is yes. Generally speaking, you do not want to convert all of your IRA money. And a lot of that comes down to things like standard deductions. You want to make sure you're taking advantage of at least your standard deduction and things of that nature. And again, it's a diversification play, right? Putting all of your eggs in the after-tax basket is just as bad of an idea as putting all of your eggs in the pre-tax basket. There are certain clients, I will say this, that we have done that for on purpose, because by doing that, their taxable income not only basically took them off the grid, but their Social Security is now coming in tax-free and things like that. That's rare. To be able to get to that point where you can kind of live an off the grid tax life and still be able to, own a home and drive a car
Sure.
and do all these things. That's hard to do. And so those are rare circumstances. So generally speaking, I would answer, you should not convert all of it to Roth over time.
Yeah. I think most things in life don't operate in absolutes, right?
Yeah, exactly. Question here. If you want to maximize income in a specific bracket, how do capital gains affect your AGI?
So capital gains actually fall into a completely different tax structure than the rest of your income. If anyone's been at Brad's other webinars, he has like a seven-step tax structure that he talks about, and then a 3-step. So capital gains are in your 3-step. And so potentially they could even be taxed at 0% depending on your other income, but the max is 20. So it's 0, 15%, or 20. And the rate of capital gains that you pay depends on how much other income that you have. So again, this can really be maximized in planning if we're looking at how much of your income is coming in post-tax versus pre-tax, because then it can impact what you're paying on your capital gains, the tax you pay on capital gains, the tax you pay on your Social Security.
Yep. Perfect. Another question here, but this was back in the Roth conversion conversation, basically aren't your taxes lower in retirement? And the answer is maybe. I've seen both. I've seen clients actually have that their taxes go up in retirement because of the lifestyle that they're leading. And that, I know some people don't understand that, because if you're living on 100 grand a year in your working years and you're living on 100 grand in retirement, trying to maintain lifestyle, how can that happen? I'll give one example. If you're a small business owner and you're living on 100 grand a year, there's ways to make that a much more tax efficient 100 grand. And you get your retirement, it becomes IRA distributions. You don't have all the flexibility you did as a business owner, and all of a sudden the same amount of income your effective tax rate can go up because of that. And so the bottom line is, to the person that asked that question, it depends. It may be lower and it may not, but that's what the point of mapping this stuff out is, and figuring out if you're going to be in a lower rate or a higher rate and how to plan for that appropriately. So here's another question. If we have taxes withheld from an RMD and from Social Security income, is that considered paying taxes at that time, or do you still need to pay an estimate quarterly? I'll let you handle that one, Carly.
Yeah, it depends. So if those were your only sources of income and you're withholding tax, that is treated as if it was withheld continuously throughout the year. So if that covered your tax liability, then you would not be required to pay in any quarterly estimates. And there's no evaluation of how much money came in when. They treat it as if it was evenly contributed throughout the year. If that is not enough withholding to cover your tax liability, and we're looking at some of the safe harbor rules that Brad talked about earlier. So let's say it's more than $1,000 under, that's an easy one to talk about. Then there is an expectation that you would, in addition to that withholding, also pay quarterly estimates to cover that difference.
Yeah. Great answer. Question, shouldn't the possibility of one spouse passing and putting the other in a single tax bracket be a factor in deciding to make Roth contributions or conversions rather? Yeah, absolutely. If you're unfamiliar, if you're a married person now, when your first spouse passes away, you no longer get to file as a married person because you're technically, you're a widow or a widower. And so you no longer get to file in the married brackets, which have higher thresholds. You have to file in the single brackets. And of course, that's going to affect your overall effective tax rate. And so that does need to be a factor in the decisions. And unfortunately, there are times in, my career here at Fiat that we've run into very significant situations where, spouse A is terminally ill. And so that is going to massively affect our long-term tax strategy. I mean, at the end of the day, you and Carly, you and I could both get hit by a bus tomorrow, and we can't plan for that kind of stuff necessarily in a meaningful way anyway. But if we know that things are coming, then yeah, obviously that's going to affect how we line things up. Limits on Roth conversions, we answered that. No, there is not. There are no income limits on Roth conversions.
Wild West.
Yeah, Wild West. Today is the Wild West. It didn't used to be that way. It is today. They want to take it away, but today you can do whatever you want. Yeah. Here's a question. It seems like income tax is higher for self-employed individuals. Is that true? And if so, why?
It is, but you're paying a different type of tax. So we're not talking about just income taxes when we're talking about self-employed individuals. We're also talking about what we call self-employment taxes, which are those Social Security and Medicare taxes. So if you are a business and you're employing people, you're responsible to pay employer taxes on those employees. If you're self-employed, you have to pay them on yourself. So it's the same tax rates across the board, whether you're the business or you're the individual. We all pay the same rates of Social Security. You guys have probably noticed that on your W-2s when you had W-2 jobs, that Social Security and Medicare are being taken out. That's the employee side. So there's two pieces of it. Yep. And when you're self-employed, you actually pay both pieces, the employee and the employer side. There's a cap on Social Security, but there's not a cap on Medicare. And so it is, I mean, it definitely is a higher tax rate when you consider both of those things. But you're paying into your future for the Social Security, right? I mean, that's what we're hoping.
Yeah.
Now you sound like you work for the IRS. I should open that.
What about moving already taxed RMDs into a Roth? And the answer is you cannot do that. You cannot take an RMD and convert that, so to speak, into a Roth IRA. It's not allowed. So if you're of RMD age 72 or older and you have to take that required minimum distribution, that has to come out and it has to get taxed. And if you want to do a Roth conversion, it has to be above and beyond whatever your RMD was for that year. And then basically the additional part of that was, I don't know that I see the value of putting the money in the Roth. Now, as it relates to the RMD, you can't, so there's no value. Above and beyond that, if you just take the RMD out and you don't need to spend it, and it's just money that you're just going to save anyway, but it had to come out of the IRA. If we could put that into a Roth, which we can't, but the value is, if I just put it in an after-tax account, the growth is taxed at a preferential rate that Carly was talking about earlier, at a capital gains rate, still better than ordinary income, but it's still taxed. The Roth, it's not taxed. Of course, if I can get tax-free growth over taxable growth, I would want to choose that in that scenario. But again, you cannot convert an RMD. If your spouse passes on during the, two more questions we'll answer here, Carly, and we'll call it. If your spouse passes on during the first quarter of the year, are you able to claim married all year, or do you have to change to a single filer?
You have to change to single. There is a qualifying widower, which is if you still have a dependent child at home, then you can file and get a little bit more preferential rate that's effectively like a married rate. And it's better than also, like, because there's also head of household. But you know, ideally, you don't still have kids at home when you're in that spot. And so you would switch to single. All of your, in general,
Carly,
all of your
clarify,
tax statuses.
Is that the year that they pass you have to switch, or is it the year following the year that they pass that you have to switch?
Oh, I'm sorry. So the year that they pass, because they were alive and presumably also had income, you would report their share of their income for the portion of the year that they were alive on your joint return. But then you do need to switch after, and if you don't have a dependent child at home, then you switch to single. It's interesting. Most statuses you look at where you're at as of December 31st.
Yep.
That's in general kind of the way you look at it.
But we had a couple questions here just on limits. Things like 2022 AGI for not affecting Medicare. 2022 AGI did not dip into that 20% cap gains rate, but to stay in the 15% bucket. I'll say very quickly here, as a follow-up to this, for everybody that attended the workshop today, we have a couple tax cheat sheets, just one-page cheat sheets, again, to give you all these guidelines of where the limits are at, not just for things like Medicare premiums, but also for contributions to different types of accounts and where the brackets stand, all that kind of stuff that could affect you. So we will just send those out to all of the attendees, and that's going to answer all of those questions. Carly,
that's awesome.
To all the attendees that are still here, I want you all to know, because this is how awesome Carly is. I asked her to do this yesterday, and here she is, just doing a wonderful job. I couldn't thank you enough that I didn't have to stand here by myself without Matt and talk about taxes. Not only did you add a ton of value from your education, but just in overall conversation, just fun to have you here. So thank you so much for being here, giving us an extra 13 minutes of your life that I didn't ask for in the beginning. And if other questions come in, Carly, that I can't answer as a financial advisor, I will do the best I can to work with you to get answers to everybody. A lot of wonderful questions. I'm going to have, my staff hates when I do this, because I'm like Oprah and I'm like, you get this and you get this. And then it's up to them to like take care of everything that came out of my mouth. So now Courtney and others are going to be busy sending things out to people. But we'll work with you to kind of get you some of these fun things. These candles smell great. It's been sitting here this whole time. But Carly, again, thank you very much. Thank you for attending the March Inner Circle Workshop, everybody. This does get recorded. If you've ever asked us in the past, we do record these. We do have to send them through compliance to get them all approved and things like that before we get to send them out. But once it does become approved, if you want the recording of this, just let us know and we'll get it out to you as well. So Carly, have a wonderful Wednesday.
Awesome.
Thank you for
Thank you
joining
guys.
us.
I really appreciate it. It was fun.
All right. See you, everybody. Have a wonderful day.